So, hello everyone. Thank you for joining us this morning. My name is Lindsay Redden and I am a wealth planner for Thrive Wealth Management. The focus of my role is on retirement, succession, and estate planning in the agriculture sector. At Thrive Wealth, I have the opportunity to bring in experts to discuss topics on the minds of Saskatchewanians, and today we have partnered with Doug Carroll, who is a tax and estate specialist, and we're going to be discussing cabin and cottage succession planning. This process can feel overwhelming, so I'm happy to be able to bring in Doug to share his knowledge with all of you today. A few housekeeping items before we get started. I just want to let everybody know that this session is being recorded. And if you would like a copy of the session, please reach out and we would be happy to provide that to you. Also, if you have any questions during today's webinar, we'll have a Q&A at the end. And finally, if everyone can make sure your microphone is muted during the presentation, that would be great. I'm very excited to have Doug Carroll here to discuss cottage and cabin succession planning. Doug is the tax and estate specialist for Aviso Wealth, a wealth management partner to credit unions across Saskatchewan and Canada. He previously ran an estate planning law practice and was an advanced case consultant with a life insurer and a mutual fund provider. Doug holds a business degree and a Master of Law specializing in tax and is qualified as a certified financial planner and a trust and estate practitioner. With over 25 years experience and expertise, we are fortunate enough to have him here to present for us today. And without further delay, I would like to welcome Doug Carroll.
Thanks, Lindsay, and I'm going to wait until you give me the thumbs up that my screen is on and that the visual is showing there on the slide, and then I'll kick into it here. So as far as I can see red lines around things. I think I'm on, but you just let me know.
All good.
Okay, so I appreciate everyone coming in here today, and just as a note, and Lindsay and I were talking about this before we got going here. The hot weather that we've been experiencing across the country continues to be the case where I am, which is in southern Ontario. So I'm kind of in shirt sleeves here, and I have a fan running. So if you hear a little bit of a hum in the background, it's necessary so I don't sweat on camera here. So the topic here about cottage and cabin succession, being myself someone who grew up in Ontario, I tend to use the phrase cottage, but I know that in much of the country, cabin is the reference to the vacation property, the family recreational property, and particularly in Saskatchewan, and that's kind of where my parents, who are both from Saskatoon, and my older siblings who grew up in Regina, they do talk about cabin as opposed to cottage, and I kind of go back and forth on the phrasing. So that's what I'm going to be doing here. If I swap the words back and forth, there is no distinction from the legal and tax and the interpersonal part of things if I happen to say one or the other. And just as one further note, as we're doing this, I was looking at the map recently and saw Waskesiu, which is where my parents used to spend their time. And we got pictures from them at Waskesiu back in the 1940s, believe it or not. And that's a place that they had been for their vacation time, although they didn't own a place in the area. So I'm going to talk here about cottage and cabin succession, and I've got a number of topics that I'll get into here. 10 topics, 10 slides, with some of them with a little bit more text than others. I try not to be overly text heavy, but I won't be whipping through them. There are a couple where I've got visuals or I got longer explanation of things, and again, I'll try to be slow going through those so you don't feel you're being bombarded by the content. I'm not going to get into, other than one example of what happens with capital gains, I'm not going to get into anything where you'll have to be calculating figures in your head, let alone trying to figure it out on screen. Most of it will be text-based or visuals that you should be able to follow. So I'll start with just a background of the nature of the holding of a recreational property in the family, then look at one of the key issues that comes up is what happens with capital gains and how does that affect your decision making, or if you don't have it as part of your decision making, how does that impact things from a tax perspective after the fact if you haven't planned for it. And then going back to the planning side, how might you go about doing the transfer whether it's transfer to family members or selling elsewhere, but particularly transfers within the family, where you can have some options rather than a straight up direct transfer to the kids, the adult kids, or via the estate as a default. You may have other options that you can look at to do that. And because there are tax implications most often involved, what role might insurance play, life insurance, in trying to address those tax issues? So I'll take you through these topics. As I said, I'm going to start with this more of a groundwork, non-technical view on things. And as Lindsay mentioned, I did run law practice, where principally I was doing tax and estate planning, mainly estate planning early on, with people, seeing them in their homes, and the way I was running law practice, and the conversations that we would have about the more troublesome decision making quite often did attach to the cottage property, as we call it here in Ontario, because we had people who own these properties and had emotional attachment to them, even more so than the family home. The cottage property had those kinds of feelings and implications. So it's more than just a dollar value asset. How much do I focus on this fairly large, substantial portion of my estate on transferring that over to the family members? It's much more beyond that, because quite often the parents who own the property currently are thinking back in terms of how they individually or together had received this property and enjoyed it when they were not the owners, but they were the next generation, potentially the owners. So the past history that they had and the transfer onto them, and then the current family that they have and their own children, and how they may have used it as their children were growing up, and the belief or the expectation that their own children would be able to do the same thing. So there's a lot of timeline in history that can be decades and decades along, and multiple generations, that do make it a very emotional kind of place. And it does tend to be, as opposed to the family home, which also has emotional attachment, as opposed to the family home, the cottage or cabin is a place that there would be intended family gatherings for special events, whereas the day-to-day stuff more so would be what would be at home in town, where the principal residence, the main principal residence might be. And so it tends to be those places where, whether you got pictures or not, you do have this attachment to the positive aspect of it, and wanting to enjoy that and transfer it on and open up the possibility for the next generation to do similarly. But you have to be practical about that. In part, the transfer may very well be sustaining that memory, your own memories, and opening up the memories for your own children to create their own traditions, building off of what it is that you've built. But you have to be practical about it, as much as you, as the owners. When I say you, generally, as I'm speaking here, I'm talking about the current parent owners. You, as the people who are on title and have this property, you probably do want them to carry on in most cases. If you didn't, then you just sell it and cash out, and it'll just be part of your assets or part of the estate assets. So, do you want to them to carry on? And you got to be careful that you don't allow that to color your understanding of where they're coming from, whether they actually want to carry it on. As I'd run into it a number of times, where parents had a large concern about maintaining the property, keeping it intact in order to transfer it on to the kids. And then in the fullness of time, as we had further conversations, as we would meet, and then they would bring it up with their children, because I would suggest to them it might be useful to find out the children's intentions. Quite often the children would not be taking it over themselves. They didn't have the ability to do that because of geography, because of cost, because of other commitments, and so the parents were worried about nothing, but they were worried about something that would not actually be carried out. Apart from the individual children, then, if you want for this to be carried on by more than one, if they're going to be owners of the property or at least users of the property together, either at the same times or trading times, do they get along right now? Because if there's one thing that's going to cause more grief, more tension, it's going to be coordination of something like that if they don't already get along with one another. And then it depending on how you have looked at the way that you had built up your ownership in the property, you may very well, in a number of cases, you may very well have taken your excess money that otherwise would have gone towards retirement savings, towards funding your later years. You may very well have devoted a larger proportion of those available surplus cash amounts in the past towards purchasing this property because you wanted to enjoy it, but also because you felt that it was something that eventually you could sell and you would cash out and that would assist you in your later years. But if that's the case, then you're looking at them to buy from you, at least to some extent. And if they don't have the money to do that, then that's going to be difficult for you to be able to have that as a source of your income in your later years. And completely apart from that, for them, do they have the money available to do that so that they can enjoy it likewise? Do they have the same kind of belief structure of how they're going to devote their monies, both in terms of purchasing it from you as the first step, and then in maintaining the money? And then you might look at it as, no, this is excess money. It is not something that you're looking to live off of. You may very well want to gift it over to them, and if you gift it over to them to do that on a current basis, then can you afford that? Can you afford that in terms of the tax bill that will arise from just giving it to them, and then having to come up with cash from some other place in order to pay the taxes if they are not purchasing it from you? So the cash is not coming from them, and yet you're going to transfer to them. You're going to put them on title to the property, and I'll talk about variations of how that might happen. And then they will have the property, but you will end up with a tax bill in the year that you do the transfer to them. So I'll go into the capital gains implications a little bit further on. So in terms of the overall across the country movement of real estate, we certainly have seen a rise in real estate values over the last couple or few decades, and generally real estate does tend to rise in value. That's the experience we've had across Canada, and particularly we're talking about vacation properties. There have been, depending on the location, there have been some really significant rise in value for some areas and some individual properties. If you have had a rise in value, then one of the things to be aware of as you're looking at the eventual future tax implications is keeping records of how you have dealt with any improvements to the property. Did you keep the receipts? And if you haven't yet, then you should, as you're looking forward, keeping the receipts on any kind of additions that you've made to the property, because that can increase your cost base, which I'll talk about in just a moment. That can increase your cost base, which then reduces your eventual capital gain. The unfortunate part of making improvements to a property from a tax perspective, if you've done the work yourself, is that your sweat equity of building out that additional sunroom or that side building, that is not going to increase your cost base on the property. And that's, again, something that might have been perhaps more common in the past, though there are a lot of do-it-yourselfers that may very well continue to do that. Your sweat equity will not increase the cost base. So as you look at the transfer of the property, then what is going to be the implications of the capital gains? How is it calculated, and how much will it be in your particular circumstance? And then when that comes about, how much or where are you going to get the cash in order to pay for the capital gain that might be involved? If you do a current transfer of the property, not between spouses, but you do a current transfer to any other family member, anybody else actually, who is not a spouse, then you're going to have a triggering of the waiting capital gain. It'll be a current tax liability that will have to be paid the following April when you file your tax return. There may be ways that you can defer that, and we'll get into that as possibilities of setting up a trust to transfer the property into, so that you can defer off the capital gain, but end up with the transfer, or the intention of the transfer, of who is going to receive it, being clear in terms of the legal rights that will follow. That's certainly something that that might be considered by parents who are, I wouldn't say necessarily elderly, but are at least to age 65, because there are certain trusts you can use for doing that allow you to defer off the capital gain. And then if you do have the property that you own at the point of your death, then there will be a deemed disposition. We have actual dispositions where we sell things, where we give things away, which is an actual transfer and a disposition of the property. And then we have things that are called deemed dispositions, where the tax rules treat it as if it had been a disposition because of a particular event. And death of a person is one of those events that happens. And when that happens, then the estate of that person will be responsible for the tax on the capital gain before you can transfer over to those who you name as the beneficiaries, the intended beneficiaries, out of your will. So the Canada Revenue Agency will collect the tax liability from the estate. It doesn't have to come directly from the property that's involved, but it does have to happen, has to come out of the estate. So where is that liquidity going to come from if you intend to hold right up to the point of your death? Does it mean that you're going to keep the cottage or cabin as it is, so it can transfer to whoever it is that you want it to transfer to, and then you use other property that is in the estate to pay the tax bill? Or do you set it up in such a way that you will do the transfer over to those intended beneficiaries? And when I say this, sounds really sterile, but it's likely going to be your own family, your children, adult children. So do you transfer over to them via your will, and it is subject to them being responsible for the tax liability back in the estate? Is that one of the ways you can do it? And that's usually the reason why you would do something like that, is if one or more of your children are the beneficiaries, the intended beneficiaries of that property, but then you have other beneficiaries in the estate who are not going to get that property, then you might set it up so that those who receive the property receive it net of the taxes associated with it. Otherwise, those who don't get it end up bearing at least part of the bill for the taxes, and yet they don't get the ownership that comes out of it. And then the other possibility, the main possibility of dealing with the taxes, is to put life insurance in place. So I will go through these variations now. I'll break things out a little bit more, and specifically, I want to take you through the capital gains calculation. This is one of those slides. This is the one that's really text heavy, which, with my apologies. The calculation of capital gains is based on what is your cost base and what is the market value when you sell the property. As I said, you have a taxable event when there is a disposition of a property. So that will be an actual disposition, so an actual sale to someone, or a deemed sale, which would include a gift of the property where there's nothing that is transferred hands in terms of remuneration or compensation in the other direction. Or you also have a deemed disposition when it happens at death. Now, if you transfer property to a spouse or to a trust where the spouse is the beneficiary, there's more terms to it than that, but the clearest example is where the spouse is the only beneficiary of the trust, then you can roll the property over to a spouse without triggering the taxes. It will be at cost base that you would roll over to the spouse. You're entitled to do that. You don't have to. You can elect out of it, but you will then defer off the eventual capital gain. And that can happen during your lifetime, or it can happen at death. So the disposition, if there is a disposition event, then we do a comparison of the fair market value and the adjusted cost base of the property. The fair market value is the value that would apply if we had two completely arm's length parties. So if you sell it out in the open market, then there's no question about what the fair market value is. But where there's family involved, and particularly where there's a gift or there's death that happens, there is nothing that you can look at and say definitively, this is the price that was involved here. But the taxes will be calculated based on what is the fair market value if it had been done as an arm's length transfer. Sometimes what people will suggest, maybe believe they can do, is to transfer over to, particularly to a child, at some nominal value, $0 or $2 in natural love and affection. And that's fine in terms of you as the transferor not wanting to take anything back, but the tax rules will still treat it as if it had happened at fair market value. So you didn't get anything back on the other side, but there will still be taxes to be paid based on the actual, or not the actual, but the determined fair market value of the property. And so it'd be the fair market value minus the adjusted cost base. And the reason why it's called adjusted is because the original cost base of the property will be what was paid for it. And then there can be adjustments that happen subsequently, like if you make some significant capital improvements to the property. And the example I always use is you added a sunroom. So it's a new portion to the property. So that addition, the labor that you paid for, the services associated with it, and the materials involved, that will increase your cost base on the property. So we have that as our capital gain, which is the fair market value minus the adjusted cost base, and then the taxable part of the capital gain is 1/2 of the capital gain. So let me take you through an example here. And hopefully this will make it a little bit clearer with the numbers. Again, a lot of text, but let me take you through this. I'm going to treat this as a person who is a top tax bracket taxpayer at the time of the sale of the property. That's really what matters, is the taxable event when the sale happens. And it just makes it simpler if I just say this person is top tax bracket at a 50% top tax bracket. Just a round number. That's about where the top bracket is across the country. So we've got a property which was purchased for $300, sold for $500. So we're just dealing with it as a straight sale now, to not getting into the complications of transfers among family members. So we've got $500,000 is what was paid by the purchaser. Over the course of the years of ownership, doesn't matter how long, but we got $5,000 that was the cost of the upkeep for 20 years that the place was owned. There was a $40,000 sunroom, surprise sunroom, that was added, and then on the date of the transfer, the $500,000 was the purchase price, but then there was $20,000 in closing costs. The most significant one would of course be the real estate commission, usually, that if this was done through real estate agent, as well as legal costs and some other closing costs. So we've got $500,000 minus the $20,000 for the closing cost. Our fair market value then is $480,000. And then our adjusted cost base is the original $300,000 plus the $40,000 for the added sunroom. The $5,000 per year over the course of the 20 years, the $100,000 for upkeep, is not a capital cost, so that does not affect the tax result here. It's simply an upkeep that you're responsible for. It's a personal cost. It doesn't get into the calculation. So we have a capital gain of $140,000. Half of capital gains are included in income, so that's $70,000. And then the person that we're talking about, as I said, is top tax bracket. So you end up with $35,000 in tax to be paid in this example. And then if you had two spouses who were equal owners on the property and they'd each contributed into the purchase of the property, then the tax on the capital gain would be split between the two of them. So the taxes can be very significant. This is not a lot of gain that we're showing here, a couple $100,000 gain over the course of 20 years, particularly the last 20 years, you could have seen gains that add an extra zero onto these. It could be much larger, but that gives you an idea of how this works with the capital gains calculation. One of the things that that people will look at this and say, okay, well, this property, it's a home as far as we're concerned. We've used it as our principal residence in a sense, but do we fall within the tax rules? The suggestion sometimes is the idea that you could have your home in town, as I'll refer to it, your main home, and you have your cabin, your property, which is recreational. And when you move from one to the other, you can change the treatment so that you get the benefit of the principal residence exemption. So let me run you through the principal residence exemption, which I think is probably familiar to anybody who owns a property in Canada. It's one of the nicest tax benefits that we get, that it allows for the growth in value of a property that qualifies as a principal residence not to be taxed on the capital gain. So in order to qualify, it has to be a property that is ordinarily inhabited in the year, and that's probably quotes around that, the definition under the Income Tax Act. It requires that it's ordinarily inhabited during the year, and that does not mean that you have to have a particular number of weeks, months, days, whatever it might be, in order for it to qualify. It just means that it has to be a residential property which is used as such for some time during the course of any given year. As I said, this is one of the largest tax benefits that we have in our system, and the concession to it, though, as a couple, is that you share the principal residence exemption between the two of you once you become spouses. Whether you are legally married spouses or you are common law spouses, you share the principal residence exemption between you. In terms of residency, it's available for the sake of Canadian taxes, and so in order to make use of it, you have to be a Canadian resident owning that property. But the property itself can either be in Canada, it can be in another province, it can actually be outside of Canada in order to still qualify for the principal residence exemption. And the calculation for this is based on trying to make sure that there isn't any gap where you don't get the principal residence exemption. So the calculation has this funny little 1 plus calculation. So it's 1 plus the years that you are claiming the principal residence exemption divided by the years that you owned the property. Most often what happens is you claim the principal residence exemption when you sell a property. You don't do it every single year and say, oh, things went up, things went down, I want to switch from one to the other if you have multiple properties. It's just at the year when you transfer, when you sell a property, you decide how many of the years of your ownership of that property you're going to claim as the principal residence exemption. What the 1 plus does is it allows for the fact that you're going to have a transfer during the course of any given year, that if you could only claim it on one property, the one that you owned for the first part of the year, and not on the one that you then owned on the subsequent part of the year, you would end up with some part of the capital gain being taxable. So the 1 plus makes sure that you don't fall into that problem. It gives you a tiny extra benefit if you own two properties overlapping. But I want to come back to this point about moving from one property to another. So here's the quote over here on the right-hand side. We'll move to the cottage and make it our principal residence. So people, when they are coming towards their retirement years, may very well say, hey, we don't want to maintain these two properties. We don't need to live in town anymore near where work was. We're going to sell that one off. We're going to move up to the cottage or the cabin, and then that'll be our principal residence. And so we'll never pay tax on capital gains here. What a great idea. Except that Canada Revenue Agency has thought about this, and it doesn't actually work exactly that way. You do end up having to coordinate the claim of the principal residence exemption. So let me give you this example here. We've got the two properties, and the house is purchased, so I can get some round numbers here. The house is purchased in 1990. The cottage or cabin, but I'll just say cottage. The cottage is purchased in the year 2000. So the arrows there on the grid on the right, the timeline, show you the purchase time of the two properties. And then we have the sale of the house happening in the year 2020. So it's been owned for 30 years. We then, as owners of the property, the person who, or the couple who own the property, can decide how many years they want to claim as principal residence. And as quite often happens, but it's their decision whether they want to do it, whether they're aware or not of the implications. Quite often, the entire time of ownership will be claimed under the principal residence exemption in order not to have a current tax bill on this sale of the property. So the property is sold there in 2020, and the claim for the principal residence exemption over the entire 30 years in this example, then make sure that there is no tax that applies on that transaction. But the question is, what are the implications for the cottage property, because you have concurrent years of ownership between the two of them? So what we're going to do then is we're going to sell the cottage property 10 years later, where they move into some kind of different accommodation. And so the 20 years of concurrent ownership of these two properties between the year 2000, when the cottage was purchased, and the year 2020, when the house was sold, well, the principal residence exemption was claimed on the house for those overlapping years. And as a result of that, the claim on the cottage is reduced when the eventual sale of the cottage happens in the year 2030. There are only 10 years that can be claimed by on the sale of the cottage because of the overlapping years when it was claimed on the principal residence in town, the house in town. So you end up with, in this example, you have 10 of the 30 years, so 1/3 of the capital gain on the sale of the cottage will be taxable. And it's not specific years, as I mentioned earlier. It's not a matter of saying, well, 2014, the markets went haywire and cottage properties went up and in-town properties went down. You don't choose particular years. It is simply a matter of the number of years over the course of the ownership. And even though I'm showing this growth in value as a straight line, of course, we know markets go up and down, and it's not really a straight line. It's just the end value that I'm showing at the end of the green triangle where the property value is. But for the capital gains, or for the principal residence exemption, again, it doesn't matter what's happened in between. It matters what happens on the point of a disposition and how many years you choose for the principal residence exemption when that occurs. So let me move over and look at the two most common ways that people will own property, because this gets you into the possibilities of how you're going to transfer over to the children that you have. Again, I'm assuming that there's a desire to bring the children into ownership in some way, whether the parents continue to be owners or transfer over to the children to take over from there. So there's two common ways that you will have ownership among more than one person, so two or more. So it doesn't have to be just two, it can be two or more, but the way that I'm going to illustrate this is just to show two people who might be involved. So under joint ownership, which is probably the default that most people think about, and that's because we tend to think about ownership between spouses. You have, under joint ownership, an equal undivided interest in the entire property that each of the joint owners hold. So if it's a couple here, again, it doesn't have to be, but if it's a couple here, we've got two joint owners, and between the two of them, they have an equal undivided interest in the entire 100% value of the property that's involved. And the benefit of joint ownership, quite often that's highlighted, is where there is a death of a joint owner, then the surviving joint owner, or owners, multiple, if we have more than two involved, the surviving joint owners would continue on in their ownership of the property. The interest of the deceased person would not fall into that person's estate. It goes over by right of survivorship, by the legal title of the property as it is in the land records, over to those surviving joint owners. Between spouses, as I mentioned about the transfer of property between spouses, you roll property over at adjusted cost base. Again, you can elect out of that depending on your tax circumstances. You might prefer to have some or all the taxes triggered on one spouse's death, but usually what happens is we transfer over and there is a deferral of the capital gain on the transfer from one spouse to another. Where you have others involved, though, and particularly in the examples that we're using here, where you have children, adult children, who are added onto title to property, then you will have dispositions happening of the property to those people where there's going to be tax on that kind of transaction on the gain. So that's a joint ownership arrangement. Then we have what's called tenancy in common. And with a tenancy in common, you may very well have equal valued interest in the property, but your claims on the property are distinct from one another. And again, we can have more than two, but in this case, we've again showing the two, what are called the tenants in common, or the two tenants, who own together the entire value of the property, but this might be 50-50, or it might be 2% and 98%, or any other proportion. And again, we can have other people involved in this arrangement. From an estate planning perspective, the implication of a tenancy in common is that instead of the interest of one of these people when on their death going over to the surviving owners of the property, it goes into that person's estate. And that is probably a more likely intended result, where you have people who are not spouses for one, but are not directly connected in terms of the transfer of their property through their estates. So we've got situations, let's take it out of the cottage property. Let's say that my brother and I decide that we're going to buy a rental property and make a business activity out of it. We would likely hold that property as tenants in common, because if I die, I don't want my money, my ownership interest to go over to him. I want to go into my estate for the benefit of my wife and kids. And so a tenancy in common makes sense in that kind of a situation, rather than a joint ownership where he ends up being the full owner of that property and my wife and my kids are out of luck on that arrangement. So there's our two main types of ownership. Let me take you through some options now of how you might use that to do the transfers. So I'm just going to use the visuals here. I'm not going to get into any numbers. So we've got the parents here as the current owners, or you might have the survivor of them. And I'll talk about it in terms of the survivor, just so I can give you the math. I'm not going to do complex math, but to give you the math involved, where you've got one current parent owner, the other one has previously died, and so we had the transfer under joint ownership to the survivor. And then the current owning parent might look at a couple of possibilities, or a few possibilities, of how they might add on the one or more children to ownership of the property. So one of the possibilities is the parent might do an outright gift to the children, or they might do a sale to the children, which would be a complete disposition of the property from that parent over to the children. Again, whether it's a gift or it's a sale, it is going to be a disposition. So that's one possibility, and there'll be capital gains that would have to be paid on the disposition of the property from parent over to the children, and the capital gains would be based on the fair market value, as I talked about earlier. Another possibility quite often that comes up is this might be shortly after the death of the other spouse, and the parent then is looking at the kids and saying, hey, these kids are going to end up with this property anyway. What I'll do is I'll add them on as joint owners. And again, I'm just going to have two kids here involved. I'm going to add them on as joint owners. When you add on non-spouse as joint owners in the property, in this case, a surviving parent adding on two children, then the parent is deemed to have disposed of 2/3 of the value of the property, because there's one owner originally, and now we've got two more, so there's three owners, just for the sake of my math. So don't take that as it's always 2/3. It's just because I'm adding two of them on that we have a 2/3 disposition of the property. So the parent, on adding the children on as joint owners, will have a deemed disposition of 2/3 of the value of the property. And yes, it will be then held as joint ownership among the three of them, but the parent will have the disposition and the tax to be paid on the disposition of the property. Now, it is possible, and this is where you have to talk to a lawyer to make sure that it's done properly, it is possible to add to ownership and not have the taxable disposition occur, but you have to really be careful how it is documented in the transaction and any kind of transfers among the people who are involved. So a real estate lawyer, absolutely critical to have the conversation with to make sure that you understand and that it's properly documented. So in this case, we'd have the two children added on, and then at the point of the death of the parent, then the two children would have, as the surviving joint owners, the continuing ownership of the property. But you now have two children who are siblings of one another, who are joint owners of a property. And as I said, with my example where we had the rental property, my brother and myself, that might not be the best way to go about it, because the interest of each of them in practicality really should be going down into their own children. And so that makes for more complication of how you set up the ownership of the property in the first place as the parent is contemplating this. Again, real estate lawyer to talk to. So other possibilities that you might do here. You could have the transfer from the parent. Again, I'm treating it as if there's just one here as a survivor, as I'm speaking on the slide here. You could have it as a transfer from the parent into a trust, where the beneficiaries of the trust are the parent, as well as perhaps the children and maybe even the grandchildren as beneficiaries of the trust. So that allows for the parent to set it up so that there is a known ownership transfer that will happen, and the legal ownership then is going to be recorded under the trust so that it is clear who's going to get what and when, and the children then can know that they're going to receive that. The problem with setting up a trust like this without having done it tax informed is that the likelihood is you're going to have a disposition of the property when you go into the trust, similarly to what would happen when you have the addition of the children under the joint ownership arrangement, where a proportion of the property would be deemed disposed or on the transfer into the trust, and so again taxes would have to be paid by the parent. So rather than having a tax on that transfer into trust, the parents could transfer into a trust that has a tax deferral associated with it. And that's the most common type of trust of that type of arrangement is an alter ego or a joint partner trust, where in order to set up one of these trusts, the parents, if it was one parent, then they would set up an alter ego trust where he or she would be the beneficiary of the trust for life, but then upon his or her death, the interest in the property held in trust would go over to other contingent beneficiaries, the children or the grandchildren or both. It could be the possibility. The benefit of setting up one of these trusts in this way, and you have to be at least age 65, is that there is a rollover from the individual current owner over into the trust. You don't have taxes that will be applying at the point of creating the trust. So that's an alter ego trust. A joint partner trust, the rules are quite similar between the two. The difference simply is that the main difference is that the beneficiaries for life in a joint partner trust are the two spouses, but you get the rollover, and the death of either one of those does not cause a disposition. It's the later death of the two of them which will then have the disposition happening of the property, and you would then have the contingent beneficiaries becoming into their ownership at that point. And that disposition would be that later point in time, so the taxes would apply at that point. And then the default in a lot of cases is that you continue to hold the property until your death, and then there will be a deemed disposition going from you to your estate, and then your will say who will take on the ownership of the property after that. And then the last thing that I mentioned earlier on about how you fund the taxes that might be involved in this, there might be, depending on your intentions, there might be a few different ways that you might be able to use life insurance. So One of the things you might do is if the value of the cottage or the cabin is significant relative to the other assets in the estate, then you could set up an insurance policy, and your insurance advisor could work with you to figure out what's an appropriate amount to estimate what would be the eventual tax liability on death of the second of the spouses, if we have two people who are involved here. And the idea is that you align the amount of insurance coverage so that it can pay the taxes on the deemed disposition, and then the cottage or cabin can go intact to the one or more children. However it is you want to set up the ownership, whether it's joint or a tenancy in common. After that, the key here that we're trying to deal with is not having to sell the property in order to pay the tax on its own deemed disposition at the point of death. Because if there are no other assets in the estate, then there's not going to be much option other than to sell it in order to pay the bill over to the Canada Revenue Agency. Second possibility might be that you still may set up an amount of insurance which will cover off against tax liability, but the other aspect of it might be to say, I intend for one of my children to take on the ownership of the cottage, and then in order to equalize, it doesn't have to be exact dollar equalize, but to make sure that I am in my intentions of taking care of the people around me and sharing things, I'm going to provide other things to the others who are not going to get the ownership of the cottage. I could set up the insurance policies to not only pay the tax liability, but also to be a stand-in, an equalizer, so that a larger amount of cash goes over to the other beneficiaries, the other children, who are not going to be owners of the property. So again, it's going to be usually paid on the second death of the two spouses, two parents, if you want to look at it in an after the fact basis, so that there's enough money that the property does not have to be sold to pay the taxes, and that everyone gets some reasonably equal entitlement out of the estate, and it keeps all of the calm in the relationship of the family members. And the last thing that I have here is, if this is a particularly large property and there is a significant desire to keep it in the family, maybe even keep it for a much longer period of time, and if there are multiple family members who might be using the property, whether we're talking about the next generation children or even grandchildren, then maybe what you do is you have the property go into a trust, and you set up the insurance policy to not only pay the taxes, again, the tax is always going to be a part of this discussion, but to not only pay the taxes, but also to create some kind of a fund of money which will allow for the continuing maintenance of the property, so that it can continue to be available for all the people who are involved. So there's other ways that you might look at life insurance, but it gives you a few different ways to characterize it here. The payment of the tax liability alone as a proxy for a bequest in the second case, and then as an ongoing fund to keep it going in the family, in the broader family, as time rolls on. So Lindsay, I'm gonna bring you back and see if we have any questions that came up while I was going through the material there. As I think you mentioned off the top, we do have handout material that is available to people that'll be sent, I believe, which goes through the things that I was talking about in text version. So if you didn't get all the points down, then those readings should help out fill in the gaps if I didn't cover off things directly. So I'll bring you back in, Lindsay, and see if we had any questions that came up.
Sure. Thank you, Doug. We will go into our Q&A portion before we wrap up for today. So a couple questions here. I would like my grandchildren to inherit the cottage, but allow my children unrestricted use in the meantime. What is your recommended best practice to make this happen?
You can certainly just make a statement of intention. You could transfer over to the kids, like leave aside the tax issues. I'm going to, because you have to be aware of the tax issues. But in terms of the rights of ownership, you could make a statement that this is your intention, but they don't have to follow that intention. Usually, the approach then would be to say, formalize things by having the transfer over to the children in trust, So in the trust, one of the two variations of trust that I mentioned there, and the terms of the trust could very well say that there is full availability of use by your children, and then at the point of your children's death, which would be some decades down the road, presumably, then the grandchildren would be able to use it as they please after that. So a trust would probably be the route to go.
All right. Can you explain how the 5-year capital gain reserve would work if we were to sell our cabin today?
So whenever anybody sells property, capital property, if all of the payment is not occurring in 1 year, there can be a deferral by up to 5 years. So it'll be the year of the transaction, and as far as 4 more years out in time, there's a possibility of deferring the capital gain percentage-wise over the course of that time. So if you did it as you can never claim a larger amount in a later year than you do in a current year. So if you did it evenly, you might have a payment made 20% per year over the course of 5 years, this year plus 4 years, and then the capital gain would only have to be realized as 1/5 the capital gain each of those years. So that might be a way that the incoming family members could afford to pay for it currently, and for the parents not to have as big a tax hit as would be the case if it all happened in 1 year, because we've got a graduated tax bracket system where you're pushed up into higher brackets the higher level of income you have. If you can spread that out over the course of a number of years, then that could reduce down the tax bill in doing that. It's usually something that it would be contemplated in a family relationship. Where you have arm's length people, they're not likely going to want to participate in something like that. You could do it with them, but do you really want to be tied to the people who buy your property for the next 4 years after you sell to them when you're not connected to them at all? It's just not usual that it's done in an arm's length situation. But families, you may very well be able to reduce down the tax bill by going that route.
All right, another question here. My parents own a cabin and want to pass ownership onto us children. What kinds of tax implications will there be for us if we sell the property after we inherit it?
So I went through the tax implications of the disposition. If the children are added on, and I'll keep it as simple as possible here, if we had one parent who added the one child on or transferred over to the child, whether the parent received anything back, again, it would be a transfer at fair market value. That would be the parent's tax liability on adding that child on. And then once the child was on ownership of the property, I'm going to just assume that's an outright transfer from parent to the one child or the multiple child, doesn't really matter. Then the cost base for the children is also the fair market value of the property. If they sell very shortly thereafter, then chances are there would be minimal capital gains associated with it. Although, again, we've got kind of funny markets in a downward trend right now where there have been some sharp movements in the market. But if it happens shortly thereafter, immediately thereafter, then the parent would have paid the capital gain on the transfer to the children. The children will have some nominal capital gain, if any. If the market goes down, because this is a personal use property, it's not a business use, then there's no capital loss that the children could claim on that. It's either you end up with a capital gain, or neutrally if the fair market value sale by the children is equal to their cost base, but no possibility of claiming a capital loss by any of the people involved, because it is a personal use property.
Excellent. What tax consequences should I plan for when I sell my foreign vacation property? And do you have recommendations on what I should prepare for when I do sell?
So when we have any capital transactions, sale of property, and when I say property is anything that you can own, but we're talking here about a vacation property that's located elsewhere, whether it's around the world, could be in the U.S., more often it's in the U.S., but wherever it might be, as Canadian residents, we are taxed on our worldwide income. And so there will be a Canadian taxable capital gain associated with that. So whatever the currency is that you sell for, you have a cost base, which you have on your original purchase, plus any kind of adjustments that might have happened. Again, converting it all into Canadian dollars. And then your sale will be at some fair market value, again, converted back to Canadian dollars. You'll pay on the capital gain. Depending on the jurisdiction where you sell, you also may be subject to capital gains in that jurisdiction, although it's not as often. If you're talking about the US, the amount that you sell for can have an impact on the buyer's responsibility to make a payment on your behalf of withholding tax over the IRS, the Internal Revenue Service, in which case you personally will have to file a U.S. tax return as a non-resident in order to recover that withheld tax in the U.S. So you're not taxable on it necessarily, but you will have to go through those extra steps. So selling a property in foreign jurisdiction, make sure you get foreign advice as well as Canadian tax advice on what's going to happen when you do that.
And one more question here. Would you recommend the parents own and pay for the insurance policy to pay taxes due on second death, or should the beneficiaries be responsible for this? And is there a best practice you would recommend?
I wouldn't say that there's a best practice specifically. I always that phrasing best practice, it elevates things as if it is the best or a common practice. I would say that it depends on the resources of the people who are involved, and if the parents are going to pay the premiums on the life insurance, if it is to pay for the tax liability and then it's otherwise going to go to all the same beneficiaries, one or more of the children, then it really doesn't matter practically who pays the premiums on the insurance. It either reduces the estate going to the children, or the children then are paying for something that makes sure that they get as intact an estate. But where you have the insurance policy being used as an equalization, where the children who are going to get the cash from the insurance are not going to get the cottage or the cabin property, then depending on who's got the resources to pay the premiums, it may make sense for the children who are going to receive the insurance proceeds to pay for those premiums, because otherwise the parents are reducing down the size of the estate associated with all of the beneficiaries by using the premiums for that purpose. So it just depends on where the liquidity is and whose rights we're trying to make sure we cover, not rights, whose entitlements we're trying to cover off on here. I wouldn't say that there is, again, a best practice to it. It just depends on your circumstances, what you're trying to achieve.
Thanks, Doug, for all that great information. With no further questions, and looks like we're approaching time for today. I want to thank everybody for attending today's webinar. Thank you again to Doug Carroll for taking the time for us. A reminder, the recording of this event will be available, and any feedback from our attendees is very much welcome. Finally, if you have any future requests for topics that you would like to see covered, please reach out. Have a great day, everybody. Thanks, Doug.
Thank you.
Hey, bye-bye.
I know.